Good evening. This is Ken Long from Tortoise Capital, February 27th, 2011. I'm doing this weekend webinar via YouTube because we had some difficulties with weather that made the internet connection not reliable. So, moving on. The market is in bullish normal conditions on an annual basis at 66 on the weekly RSI, so at the high end of normal. 53 right in the middle of the 10-day look-back period. The stretch above the 200-day moving average is still in the green at 13.5%, but that's down a couple percent from earlier last week. The slope of the 50-day moving average is also still positive, coated green, and that's bullish. ATR percentage is right at 1%, so approximately twice as volatile as we saw at the end of December. The market features the U.S. indices being above average in strength, with Asia lagging significantly. Precious metals are still decent. Agriculture, energy, industrials, silver, all of the usual suspects are still in play. The theoretical exposure of the ETF2 model is still at 80%. The model portfolio is at 80%. There's no change to any of the positions this week. Just update your stops. Looking at the, let's see if we can zoom it up a little bit here, at the market health check. The slope of the 30-day regression line is still favorable, although we had this little pullback from early last week. This was about a just under 4% pullback from the swing high, which is still well within market noise. 3 days of selling off into a doji and 1 day of strength on Friday looks favorable for buy on dip opportunities. We've got overreaction and channeling system signals in play that are taking advantage of that already. So right now we have prices just below the 10-day moving average in green, and it's above the 50-day moving average in red, and the 200-day moving average is still off the chart. Can't be seen. You can see Williams percent R10 signaling the oversold conditions from 2 days ago. ADX is pulled under 20, and the minus DI is above the plus DI, and that represents a weakening of this bullish trend that we've seen for the last 2 months. Right now the bears are actually slightly ahead, and the lack of trendiness in the market can be seen in the ADX declining and being below 25. Inside the ETF2 regional report, you can see again 2 of the 10 big indexes are negative on a 5-week rate of return, which gives us our 80%, 20% investment outlook for the theoretical model. The strongest sectors remain U.S. mid caps and U.S. small caps, the MDY and IWM. The 2 weakest are emerging markets in Latin America. EEM at red and 37 is really lagging. The emerging Latin America, was as bad as EEM, but has been slightly improving. There is some strength in their energy sector and in Brazil, which I think is accounting for that difference. You can see SPY and EFA are both equal at 51, almost identical performance. So Europe has really pulled back and recovered from their lagging position. Inside the world market model, the extract. This is the STR, the strength reports from ETF2, and you can see all Asia in the red except for Australia and their commodities. Europe is about equally split between yellow and white. We've got a little bit of lagging in the U.S. market in the large caps both in the Dow and the NASDAQ, but the small caps and the mid caps are very strong. Only Canada in the Western Hemisphere is really leading the way. And you can see the dramatic strength in commodities, oil, and silver. Silver has just been going through the roof. It's ripe for a pullback, but I still like its positioning for long-term gains. Among the business sectors, only energy is really standing out compared to the rest of the database, and with a little bit of consumer discretionary. So the default position right now is U.S. mid caps and small caps, slightly favoring tech over value. And then the U.S. versus the world is in better shape, along with commodities clearly leading the way. The strength leaders from the ETF top 30, all the usual suspects. Silver on top again. Oil equipment, oil and gas exploration and equipment, dynamic oil, oil services, Vanguard Energy, Energy Select Spider. If you may see a trend beginning to develop here, Dow Jones Energy, Dow Jones Oil and Gas, Rogers Agricultural Commodities, agriculture, energy. You can see the point. The first time we get to see anything other than that is down here around the technology AlphaDex and then the GSTI networking, semiconductors, mid-cap growth. So that's really where the strength outside of basic commodities can be found. The world has taken the trouble in Egypt and Libya pretty seriously. You can see again the top liquid ETFs, the top 30. Those that are in green are ones that are exceptionally volatile intraday and which make good trading candidates. So EWZ in position 9 is one of my current favorites, along with the VIX. Let's see, XME metals and mining have also been benefiting from recent strength. So that's good tactical trading targets intraday. I want to shift now to the daily report. This is from Friday, looking into Monday's opening. So again, the market mosaic, bull normal in the middle here on annual and 10-day look-back periods. No change among any of those. We can see now that on the 30-day gap stat, we're back to about 54% where gaps have reversed. What have been significant have been the gaps down. That still is a dominant trend. That 18 times in the last 30 days, 4 and 14, the SPY has gapped down. 4 of those 18 times, it has closed lower than the gap opening. 14 out of 18 times, it has reversed and closed higher than the gap opening. So that still remains an important pattern in the market and one we want to take advantage of. And then on gaps up, 10 times the market has gained, and only 2 times has it reversed to close lower. And so, this is a case of a market that no matter which way it gaps, the play has been to play for a higher close during the day. So we should take that into account during our intraday trading frames. No signals in the overreaction or channeling, although we have a couple positions still open from Friday morning. Pivot points, you can see pivot right at 132.05. You can see the S&P volatility has reversed after the last 3 or 4 days. It was approaching the boundary of quiet and now has gapped back all the way back up to its 180-day average point here at the black line. You can see how the trendiness has been slowly coming out of this market, with ADX now down below 25 and minus DI above plus DI. That's signaling a weakening of that long, powerful bull that we've become accustomed to. A lot more patterns fired based on Friday's price action, as you would expect. A lot of 551W candidates. So that's up for 5 weeks, down compared to 5 days ago, and then 1 day of white candle. So 1 day of outperformance gives you a 551 pattern, and you can see there's an extraordinary number of the of ETFs and the usual suspects in the large caps. We've actually got washout patterns now in natural gas, UNG, and Cisco. It's been a couple months since we've seen any washout patterns because of the strong bull, but we've been trading Cisco a lot from a Max Payne perspective, and it now has finally put in a washout pattern. So that's a chart that you definitely want to look at. Under the triple screen, we have General Electric, Home Depot, and Pfizer. Elder Safe Zone. The sectors that got measurably stronger Friday was Asia less Japan, mid-cap growth, and then the technology index. QTech is like the NASDAQ 100, but more equally weighted than the Qs. The VIX got measurably weaker. That's the only one that did, based on the Elder Safe Zone. The usual suspects remain in the 30-60 stealth quality report: gold, silver, Latin America, Coke, McDonald's, and Intel among the large caps. Taking a look now at the Dow tactical report. What I'm interested in immediately are Procter & Gamble, Microsoft, and Walmart, all the percent losers, especially Walmart, which is a max pain, a 10-day, 3-day. It's oversold on a 10-day index, and it was a percent loser on Friday, so that's a case of maybe a triple pain and ready to start bouncing. Microsoft was a percent loser on Friday, but it's already no longer max pain 10 and 3 days, and so that's I look for continued strength in Microsoft, and Friday's price action gives us a little favorable entry if we see some strength. More the winners from Friday: Intel, Boeing, J.P. Morgan, DuPont, and Bank of America. I like ExxonMobil going forward. The energy sector has been very strong. They've had a 3-day pullback, and they were a percent loser on Friday. That's potentially one that's going to benefit from additional catastrophe in the Middle East. Among the ETFs, silver and natural gas did well Friday, and I like natural gas because it's in a washout pattern already, and so continued momentum there offers tactical traders some significant opportunities. Lots of patterns among the Dow. You can see we get Cisco is a washout pattern. We have channeling signals for Home Depot, Microsoft, American Express, Procter & Gamble, and McDonald's. Lots of triple screens: GE, Home Depot, IBM, and Pfizer. And then the max pain candidates: Hewlett-Packard, still suffering from that smackdown from last week, negative earnings forecast. Although what I like is all this red oversold business, but it was up 1.2% on Friday, and so that's a potential max pain that we can take advantage of. Looking among the ETFs, only one doji in gold, bunch of 551 candidates: XLB, XLI, XLK, Europe, the diamonds, and healthcare. Max pain range compression, looking at the industrials, followed by materials. Looking at the 30-day regression line, again, you can see the R-squared statistic has come back to 0.64. That's because we now have had in the last 30 days 2 significant deviations from that generally positive trend. You can see what happened the last time, but that was only a 1-day pullback, followed by another extraordinary bull run. This one took 3 days, ended in a doji, and now we've got 1 day of positive moves. You can disregard that last little white candle. So I'm buying momentum tomorrow if we see it take out yesterday's or Friday's high. The stretch percentage above the 200-day moving average is still about 1.5 standard deviations above average. That's still quite extended. We're still 13.5% away from the 200-day moving average. If you believe in symmetry, we'd obviously be concerned about these 2 legs up. The question would be, is the pullback here already over, or could it last 10 days like the previous hesitation point? So I'm going to be cautious and careful with this aging bull. I'm going to take advantage of intraday tactical opportunities, but I'm not in a burning hurry to hold things overnight. You can see the Elder Safe Zone channel was violated to the downside 3 times last week in those first 3 days, and although we're back inside the channel, that was an early indication, really as early as Monday, that the previously quiet bull up had started to run out of gas. Some more just reference material. What I like about on the Dow 30 quality report, again, I look for negative 2 months ago and then improvements in the 1 month ago. So I like to see red then white, or red and red and yellow. So in this case, the bottom 3 are things that I'm interested in. McDonald's, Coke, and Intel all share those qualities, and each one of them has improved significantly compared to the rest of the database. Travelers is still in pretty good shape too. Even though it's gone from red to green, I still think there's possibility for improvement in Travelers, and so that should be on our short list for improvement as well. Among the ETFs, looking at red and then yellow, gold, treasuries, Really, natural gas has improved. Silver and U.S. real estate make up the main quality improvements in the ETF 30. Some more reference material here. One thing you can see off of this one, this is the holding X days. Over the last 5 days, everything is in the red except for silver and gold. These are all sort of natural pullbacks. The one that got hit the hardest was IYM semis. And so, but the 5-day losses in here are well within normal pullback ranges. There's nothing extraordinary about that little 4 to 5% pullback. That looks a lot like just random market noise. If you're a bull market, let's see. That's everything I want to take a look at. This is Ken Long from Tortoise Capital, signing off on the weekly and the dailies.